Good evening and good morning, everyone. It's my great pleasure and great privilege to welcome all of you for the inaugural speech of the 2023 edition of the CUFSAA North America Distinguished Speaker Series. Today's speaker is Mr. Athula Alwis, Chief Executive Officer of ALLDIGITAL SPECIALITY, and one of the distinguished alumni of University of Colombo. So welcome again.
Thank you, Chandana.
Yeah. So before we start, I would like to present a couple of house rules regarding the question and answer session, which we at CUFSAA consider as the most important part of a presentation. The question and answer session after Mr. Alwis' speech will last for 15 minutes, but we can go more if you have more questions. The way to present your questions is you can type them to the Zoom chat window, or if you are joining through YouTube, use the comment section in the YouTube live streaming. And you do not have to wait till the end to send us your questions. You may share your questions during the talk anytime. Of course, we will wait till the speech is over to share these questions. And can we go to the next slide? Yes. So Athula Alwis has 30 years of insurance and reinsurance brokering experience at premium global companies such as Chubb, Willis Re, QBE, and Munich Re. More recently, he helped guide Freedom Specialty, a startup capitalized by Scottsdale Insurance, into a success with over $400 million in revenue within 5 years. Professionally, Athula is a member of the American Academy of Actuaries since 1995, and he's a member of the Joint Program Committee for Reinsurance Seminars since 2011. Athula received his Master of Science in Mathematics from Syracuse University in 1969, and he received his Bachelor of Science degree from University of Colombo, Sri Lanka, with first-class honors in mathematics in 1984. So, as I mentioned earlier, he's one of our most distinguished alumni, especially of the Math Special program. And Athula, it's up to you now to carry out this first speech of the 2023 CUFSAA Distinguished Speaker Series.
Thank you, Dr. Goonetillke. I really appreciate your kind remarks. And I also want to thank the University of Colombo and the Alumni Association, CUFSAA, for this wonderful opportunity to be here today. I consider that a great privilege to be back. Actually, the last time I spoke to a University of Colombo audience, I believe was in 1983 or 1984, Professor Appasinger, then the head of the department, asked me to address the incoming freshman class, first-year students, as the president of the Mathematical Society. Not sure whether it exists anymore, but this was long time ago. But it was a great experience. And I think the larger message is, I think I'm truly grateful for the opportunities, guidance, and advice I received from the University of Colombo faculty during those 4 years. And then that was a critical building block of my future success. So I'm truly grateful. So today, I want to, let's see whether this works, share my thoughts on the role of InsureTech in the US commercial industry. And it is really a time of change and time of transformation for the insurance industry. Let me talk about the insurance industry a little bit. And so without insurance, right, then we cannot have business, and people cannot drive cars, people cannot own homes, government cannot provide flood insurance, right? Any business today here in the Western world, right, they require insurance. It's part of every aspect of day-to-day life, whether you are a person, business, or a government. And so we have here today once-in-a-lifetime opportunity to fundamentally change the way insurance is analyzed, managed, and delivered. I'll talk more about that in a minute. The history of insurance, I think it's really important to see, think about how it started. I mean, the modern insurance started in 1600s in London. I know the Indians, the Arabs, the Romans have their different types of insurance mechanisms, but I'm referring to what we see today, mainly in the Western world. And in the 1600s, Lloyd's had a coffee shop run by a person named Edward Lloyd. And people got together and mainly discussed how to manage shipping insurance. This is one of the earliest pictures along River Thames in London. And so this is the coffee shop. And there's a great story about at least one company, about their origins. Percy Chubb, who founded Chubb Insurance, today considered the best, arguably the best, definitely the largest commercial insurer in the world. And so Percy Chubb was one of the participants here. And one day when he was there, one of the owners of a ship came to the coffee shop and said, I need shipping insurance because my ship left this port, but it has not arrived at the next one. And he was desperately trying to buy shipping insurance for the ship as well as the cargo. And initially there were no takers. And so Percy Chubb, what he did was he calculated, right, the cost of basically sending another ship to salvage the cargo. He knew between the two ports, the water was shallow and the cost was not high. So he offered to cover the value of some percentage of the ship and cargo's value and accepted very high premium. The idea was that even if the ship is lost, he can send another ship with a crew and salvage the cargo. It was not perishable, I assume, and sell that and recover his money. So it was always about calculating probabilities. It was a mathematical exercise. And so that's the beginning of Chubb's insurance journey. And then that's how it was done. And in 2004, I believe, I had the chance to be in London, sit at one of the desks and personally watch how insurance was transacted in 1600s. It has not changed. I think that's the genesis of this journey. Insurance that started in 1600 really has not changed until, about 20, 30 years ago, how we think about insurance and how we manage it. The US insurance sector is about $1.4 trillion. And the property casualty, the commercial side, is about 900 billion. So it's about 3% of world's largest economy. And it has about 3 million employees. So it's a very big part of the American economy. So if I joined the insurance industry in 1989, and the biggest difference compared to 1600s to 1700s was we started using Excel spreadsheets. Things got better, things got easier, but the fundamental ideas have not really changed. So InsureTech is this concept that you can use modern technology and change the way you manage and deliver insurance for higher margins, cost savings, speed and efficiency, and so forth. And so let's talk about the role of InsureTech. It initially started with data analysis. And how do we think about data? How do we analyze data rather than even post Excel spreadsheets, right? And that provided a lot of insights. And that also created this term data scientist, mainly for banks, hedge funds, and private equity firms, but now for insurance companies as well. I mean, I'll give you an example, an easy one that came through data analysis. If you think about the workplace harassment, which is a big issue in the US, right? Because there are lawsuits. Through data, right, we found out that if you are at a doctor's office run by 2 male physicians, right, the chance of a harassment lawsuit is 3 times higher compared to the US national average, right? So this is just one simple thing, right? People came to understand using data. And this is the beginning of this, probably 20 years ago, that data can tell a real story. And analyzing data in a meaningful way, right, in a more granular way, provided you an edge. Now, US system is a little bit different compared to the British system. We like to have fewer rules at the beginning of any industry, any trend, right? The simple idea is that people will sue each other and the courts will eventually decide. So US is a very litigious society. Because of that, you need more insurance. And because of that, insurance companies are always looking for better and more meaningful data analysis. Now, since that time, it has moved into risk evaluation and selection. And I think it's really important that we think about each of these patterns that you see through data analysis in your risk evaluation process. So insurance is based on underwriting, which asks a couple of simple questions. Do I like this risk? And if I like it, how much should I charge for that risk? Or if I don't like it, why don't I like it? So better data analysis, right? Better information always gives you an edge. And the other part is risk management, right? How do you control your risk? How do you understand your risk better? Think about homeowners risk, right? If you want to buy a homeowners policy, in the US, in England, right, in most of the Western world, it is fairly streamlined. And I believe that is the case in Sri Lanka as well. InsureTech, what they're doing is they're sending drones and taking pictures of the home and provide a better analysis. How is the construction? How is the roof? Is there a firehouse nearby to protect in case there's a fire? Are the roads wide enough to get there? Right? Is there a high crime area or a low crime area? That type of information, right, with the analytical tools have given companies a better edge, better understanding. In fact, better risk management tools. Similar to that, loss mitigation is another role of InsureTech. Think about a large truck driving on a four-lane highway at a high speed. Now, if you can monitor driver's attention, the speed, right, whether he or she is following rules, that's a better loss mitigation tool because it reduces number of accidents. Even if there's an accident, it could reduce the severity of these large trucks getting hit, getting into accidents. The other part is if you think about the cargo, if it is food, right? In the US, there are several large ports and goods are delivered mainly by trucks, sometimes by trains, but mainly by trucks. So if you deliver food, you want to keep the temperature at a certain level. Now the InsureTechs have come up with ways to monitor the temperature, monitor the condition of the food, and hence save a lot of food being perished and again reducing losses. So there are multiple roles, and I think there is a great opportunity for these InsureTech companies to add value. And why InsureTechs rather than the insurance companies themselves doing it? So the main thing is insurance company employees have their day jobs, and insurance companies actually tried this at the beginning. They hired data scientists from banks. And when they came in, these data scientists didn't understand the insurance business. And sometimes, because of the way insurance is run, data was in Excel spreadsheets to emails to other forms that was not properly organized and prepared. So I think the task has now gone to, except for few insurance companies, a lot of InsureTechs to handle that. Same is true with new risk evaluation methods and risk selection methods. Now, another good example is like an evolving area is aviation insurance. There's a lot of information about airplanes. Which ones are accident prone, which ones are not, which ones can land on their own, right? And then they are better risks. Now, the one part that is not well analyzed is the pilot experience and pilot training. I don't know, there was whether you know that there was a study probably 10 years ago that ranked Sri Lankan pilots among probably top 10 in the world, probably because of the training, but they did not give the reasons. But looking at accidents and number of flight hours, Sri Lankan pilots were ranked pretty high. So anybody who wants to go into that segment, right, there's a lot of data available. What is the impact of InsureTech? And from where I am sitting, speed and efficiency is a big part of that, right? This society is now more and more, right, with social media, with the connectivity, is used to getting answers quickly. I'm going to share you an example later on, right? People who are willing to wait 2, 6, 8 weeks for an insurance decision, now they're looking for the decision within a week or within days. So speed and efficiency in risk management and risk selection is a big part of the InsureTech impact. We talked about trucking, right? The cost reduction is a big part. And then that leads to, all these things lead to higher margins. And I think these are all, continue to be, really impactful things for InsureTech companies and InsureTech offering. Drivers of InsureTech. Everyone talks about the impact of, or the number one driver being AI, which is true. Because if you think about the insurance industry, even 20 years ago, insurance analysis depended on this idea that you can use a straight line on an XY plot to separate good risk from bad risk, right? A generalized linear modeling. All the models, all the fancy names, fancy things were based on that simple idea. And we all knew that was wrong, but there was no alternative. Machine learning, which is one subset of AI, has told us, actually, you should use a curved line that is capable of changing, right? Because you should continue to improve the way you separate good risk from bad risk. And then I think that was a major break in the thinking of insurance. Because when you use a straight line, you knew there were good risk packaged with bad risk and bad risk, which is really bad, with good risk, right? Now, this curved line allowed some insurance companies and some InsureTechs to begin to separate good from bad. But I think the biggest impact, in my mind, came from cloud computing. That leveled the playing field. If you think about the investment world, right? It was controlled by, even as late as 20 years ago, large investment firms, hedge funds, and private equity firms. Because they had large computers, they had all the computing power, and the others could not really match that. So they always had an edge. And that was true within insurance companies as well. Billion-dollar insurance companies could buy large computers, and I have used them, and I was part of the large insurance company segment, and clearly had an edge. What AWS and Microsoft cloud computing service did was it brought this capability, cloud computing capability to everybody. That leveled the playing field. I think that is the main reason, along with capital availability, that started the InsureTech and FinTech movement. And I think you could not, overemphasize that change, that leveled the playing field and allow this creativity. And the other part is the capital availability. Venture capital firms are looking for higher returns, right? They're always looking for places where you can disrupt. And there was this idea that the insurance industry is ripe for this disruption because it has not changed in 300 years. So those two things were major drivers, and they still are in this current movement. And as I said, the customers expect quick results, quick answers, even within insurance companies. Executives expect, right, decisions quickly and with better information. APIs also play a part, and this is application programming interface. There's a whole new sub-segment with that, how to connect, how to send data and receive data in an organized manner. I believe this started with someone's PhD thesis, and like all these things, now it has become a mainstream factor. And this is all driven by underserved segments. So I'll again address that through my example. So these are the main drivers. And looking to the future, I think the major growth areas remain AI, right? I don't think we have touched 1% of the capabilities of AI. And I think the learning continues. And, connected to that is big data. Again, insurance world has not touched the capabilities of big data. One good example is ability to predict future results, right? The KPIs, key performance indicators. About 10 years ago, through a project, we found out that in the US, the unemployment rate is 85% correlated with wrongful termination lawsuits, employment practices liability lawsuits. So that's a great way to think about, right? What do you want to do in the future? Because there's a 2 to 3 year lag, and it's 85% correlated. That allows you to allocate capital and make macro decisions, right, for your business in the long run. Or look for protection, look for guardrails around your business. If you know if the unemployment rate is going up, 2 years down the line, what to expect. And APIs, as I said, will continue to play a role, and it's become its own subsegment. And one of the key things that I'm looking forward to is the digitalization across value chain. Because any insurance product, right, unless you sell it directly to the end customer, which is what some companies do in the US through auto insurance and homeowners insurance, right? But most of the commercial insurance is disseminated or distributed using brokers. So it's not enough that you have a digital platform. Can your immediate brokers use it? And can their clients use it? So the digitalization across this value chain, from insurance company to the InsureTech, to brokers, then to the end customer. The digitalization process, right, need to continue to happen. And in this environment of, right, cloud computing, it is easier. You can do that in a cloud environment, but it also needs to be accepted by the business world. And I don't think we are there yet. So let me quickly talk about an example, which is actually what our company is working on or has worked on solving. One part of commercial insurance is management liability. And management liability has two main parts. The first part is called directors and officers liability. That is the risk you take as a CEO, CFO, COO, or a board member, director of a company in running the company, whether it's misrepresentation, bankruptcy, or someone suing you, one of the competitors or vendors. And that's very real in the US and to some extent in Europe as well. The other one is called employment practices liability. That is covering the risk of harassment, at work, or wrongful termination or related to employment. So that's not mandatory in the US. US insurance is mainly managed by 50 states. Some of the insurance requirements are mandatory, like general liability, like somebody coming to your office and slipping and falling. D&O EPL coverages are not. So that's an elective for customers. SMEs stand for small and medium-sized enterprises. So this is an example for small companies in the US. These are companies with less than 100 million in revenue or less than 100 employees. And how do we solve one of the key problems that they have? So we have thought about this problem for about 8 years, right? The key problem is, how do you make the risk selection decision whether to accept a small company as a risk, and how much should you charge? That's the first question. Second one, if you like that risk and if you accept it, how do you deliver the product, the insurance policy? So that's the main thing, but the business problem is it has three parts to it. For brokers who handle this insurance, right? The premium for these small companies vary from 5,000 to 12,000, sometimes 15,000. There are two brokers involved and each broker gets about 10%. So that's not a lot of money to pay someone $150,000 salary plus benefits. So that's really a problem. And the work required, the effort, is similar to handling a $50,000 account or $100,000 account. So you can see most companies would hire young, recent college graduates and try to do it manually. For insurance carriers, the problem is again very similar, because the decision to accept or not accept the risk, the underwriting decision, if it is done manually, again, it takes time. You have to gather data, go through the data, and make that decision. Usually data is incomplete, and it takes usually 2, 6, sometimes 8 weeks. So unless they add 50, 60 people, handling these small accounts is a problem. Insurance carriers do this by asking the same person to do $50,000 accounts as well as $5,000 accounts, more as an accommodation. So they don't want to spend, or in the past have not spent a lot of money. The end customer, if you think about the business owner who runs a company, the revenue of, let's say, 50 million, okay? For them to buy insurance, the brokers are not that keen, unless it's a soft market. Insurance companies do that as an accommodation. So there are about 6 million companies in the US, what we call small companies. About 70% of them do not buy this product today. Either they don't think there's risk, no one has explained to them what the risk is, or they don't have access to brokers and they don't buy it. So that's the business problem. And here is the solution that we came up with. We basically said, let's look at the patterns that have been there over the last 2 or 3 decades. Like the earlier one I gave you, the doctor's office, right? Been 3 times more likely to get hit with a lawsuit compared to the general population. So we took a large data set and basically built an AI system around that, trained an AI system based on those patterns. And then basically looked at traditional underwriting rules, combined that here is the way the system should think about it. Because as opposed to traditional computing, where you use a predefined algorithm and you code it, right? A trained AI system has the capability to learn, right? Learn from new experiences, new data, and get better. So the separation of good and bad is done through a curved line, right? Done through a system that continue to learn and get better. And the second part is, we said, let's connect everybody and provide the information real time. So we built a private permission blockchain system, right? And basically connected the insurance company, our AI system, and the brokers. So everyone has complete transparency, right? So one of the age-old problems in insurance, the single version of truth, it's immediately solved because everyone is on this blockchain platform and have real-time data and complete transparency. And that also allows you to deliver the product, the quote, and the policy real-time, and allow insurance company to see what's going on. And so that is the solution we came up with. And that has worked so well. So the company went live. We started the company in early 2019, and we raised funds sometime in 2020, July of 2020. Went live in 2021, and it has grown pretty rapidly over the last 2+ years. Now, we talked about distribution, right? That's actually a very key part of having any type of product, right? It's good to have an idea, good to build a product, but if you cannot distribute that to your customer base, you have a real problem. So we were lucky to get help from 3 of the top 10 broker firms in the country who agreed not only to distribute our product, who spent 18 months testing our system, right, to make sure it would be acceptable to their clients. So that was a major help. And then we are really grateful for those firms spend their time and resources to help us out. Since that time, we have expanded to other broker firms as well. So one of the things that we learned is you can't just go with one product. You need to keep adding new product, keep expanding. So we started with D&O and EPL. We added a product called fiduciary liability. That is your duty regarding it protects you from lawsuits when you manage your company's retirement account. And then excess is, how do you look at larger risks? Non-admitted is we are going to work with Lloyd's of London to provide a third product, which will probably start in another 2 to 3 months. First in the US, and we are also thinking about expanding that to London as well. And then the future, right? We have several ideas. Aviation is one. So let me share a couple of comments. As I said, there's plenty of data about planes, which are the safe ones, which are the unsafe ones, accident records, everything Federal Aviation Administration publicly, make it available. One of the things that I think the InsureTech can do is look at pilot experience. And the simple question is, if we don't like people driving drunk, right? We find them, at some cases, jail them. Do we like people flying planes drunk, right? And how do we find out whether this pilot has a history of drunk driving, right? Because person who drives drunk is likely to fly drunk as well. So there are things that through web scraping and other means, InsureTech can bring to the insurance world and make the flying experience safer, manage the risk, and go through loss mitigation. So these are some of the parts that, right, we are thinking of getting involved in. And this is just a picture of the input area, and how basically the solution that we talked about. Before that, it took an insurance company 2, 6, sometimes 8 weeks to come up with the risk selection decision. Our AI system, coupled with the ability to create quote and bind, quote and policy documents, we provide the answer under 3 minutes. So that's a major improvement in speed and efficiency. Not only we can answer under 3 minutes, we can deliver the product to our broker partners instantaneously through our blockchain platform. So that we believe has been and is going to be a major game changer. And that is the main reason why we have been growing pretty fast in the US. When you think about, an InsureTech, right, there are several questions you want to think about. We talked about some of them. The idea, which leads to the product, right? And then the product, which leads to how do you distribute that? What type of team do you want to have? And then the other part is how do you get capital to start the enterprise? One of the key things VCs look at is how large is the total addressable market. And I talked about 6 million companies in the US, right, in this small company segment. Only 30% of them today buy that product. That creates about $15 billion addressable market. But if everyone buys, It's a $50 billion market. So that's what VCs look at before they investing. We have raised about $4 million so far, and about $3.5 million came from venture capital firms. So, I mean, I think that's a very important thing that all InsureTech companies need to think through. I want to go back to one of the earlier topics, the digitalization of the value chain. So we started by connecting an insurance company with its wholesale broker partners and our AI system. And now in 2022, we started connecting some of the broker partners to their retail brokers. So we expanded the digital network, basically a few tests. And how do we connect, get even closer to the end customer? And sometime in 2023, we're going to start a project that would allow us to actually touch the end customer. So I think that is the real value of this digitalization process and cloud computing, because anyone who can touch the end customer digitally, right, will control that market segment. And that is the real value in today's environment. We have an excellent team. I think I'm really grateful to have a fantastic management team, as well as a lot of very hardworking team members. And today we have 5 colleagues in Sri Lanka, all of them University of Colombo graduates. And we'll be hiring 2 more on June 1st and probably 3 more in September. So I want to recognize the role that University of Colombo and Dr. Sanjeewa Perera and team have played in becoming a pipeline and resource of talent and hardworking individuals. So we really appreciate it. Couple of quick comments about the AI system. I'm not an AI expert. We are really lucky to have 2 fantastic AI experts on our team. As I said, the training of the AI system was based on a pattern recognition. So it's a machine learning idea. And so we train the system. As we get claims, the loss data, then we'll ask the question, hey, should the system, should we have recognized, or the system should have recognized that there's a pattern in these losses, right? Then how do we make adjustments? So how would the system make adjustments? Those types of things are in our future plan. And another thing that we have done successfully, and we will continue to do, is human in the loop training. Get experts and provide experts to give guidance to the AI system, looking at good and bad, and get the system to choose a mathematical model that best fits that new criteria, and ask the question, is it better in determining good risk versus bad risk? So it will continue to happen. And that is also another part of our evolution. And this is the normal cycle that we go through, right? So the humans and the pattern recognition will say, here is good, here is bad. And then we go through that process, right? And then we come back and look at the results and ask again and see whether the system should be updated, or how the system would react to new data and new experience of losses, and go through the process all over again. And a couple of comments about blockchain. I think it provides a lot of security, transparency, efficiency, and no one can change the historical record, right? So in a very litigious society like the US, that's a really important factor. Everyone has the same information, same data. No one can go back and change it, in addition to solving the single version of truth problem. So that is the end of my prepared remarks, and let me hand it over to Dr. Goonetillke and team to see whether there are any questions.
Thank you very much, Athula. Thank you for the wonderful speech. And now we invite the audience to send in their questions. Yes, please type them to the Zoom chat window. And I believe we already have a question, so let's present that to the speaker. The question is from Angelo Gunasekara. Here is the question, Athula. Very interesting talk, Athula. My question: are there other strategies insurance companies employ to reduce premiums for doctors who practice with ethical and competent standards besides data science? Moreover, do they incorporate other approaches alongside data science methods? My concern is primarily when insurance companies solely rely on data science approaches and the result in generalized data implies, as you pointed out in your example, that 2 male doctors might pose higher risks. Is there any way to individualize lower premiums by these approaches? Or is it done solely through brokers whom the customers know and associate with?
Great question, Dr. Gunasekara. Thank you. So the main part of the question is what I heard was these. Correct me if I'm wrong. Are there other methods, right, within data science to think about these approaches, and also is there a way to individualize? So let me take a step back and say that it is always really important for us as the humans involved in this process, right, to ask the basic question, does this answer or do these results make sense? So the great question about the 2 doctors working at a medical facility, right? Can you individualize it? At this point, I don't know the answer, right? Something like that, because unless you have the history of each of the doctors, so because the hidden question is one is good, one is bad, you might still get a certain number of lawsuits, right? We are also asking the question, if 2 female doctors join that practice, would the frequency get better? There is some evidence that a 20% doctor's office with a high number of female physicians have a lower frequency, but it's not really proven yet. I'm also concerned that how do we interpret data in a siloed environment, right? How would that affect future decision making? I'll give you an example, because this is why you can't just allow AI to make all the decisions. There was a project looking at US public companies. There are about 5,000 of them, right? And we asked a data scientist to tell us what are the main drivers of lawsuits. And this is after 2001 crisis, probably a few years. Main data was used up until about 1995 through 2005 or 6. And the data scientists came back triumphantly and told us after 2 weeks, the number one driver of losses for lawsuits for public companies is the stock market, the stock, whether they use NASDAQ or New York Stock Exchange or something else. So we all started laughing because most of the lawsuits were against .com companies in early 2000s, and they were almost all of them were with NASDAQ. So there was an anomaly in data, and that led to basically a indication that the NASDAQ was the main driver. So at this point, we are not developed enough to handle that, right? So whether we use AI or whether we use strictly data science methods. And I think we should continue to look for other ways of verifying, right? Number one is the human asking, does this make sense, right? These patterns and these conclusions. Hope I answered your question.
Yeah, thank you, Athula. The second question, I don't have the name of the person asking the question, but the question is basically about a little bit more details. In insurance industry, how is big data used, and asking for an explanation regarding a little bit more about APIs.
So let me take the second part first. We use APIs, and I personally have not. I think the APIs give you the advantage of very exactly and correctly exchange information, right? You can send data in a certain format, and if the other party can accept it, right, this connection is made, and how it's formatted and how it's done. And then what type of data can be sent and what the width and so forth. So that is my understanding of APIs, and that is widely used, and it's almost like a commodity right now, the API applications. Happy to, if you send me an email, happy to connect with one of our experts and get back to you. Please let Chandana, Dr. Goonetillke know, right, your name and email address.
Yeah, in fact, thank you, Athula. The question came from Janendra Bhogawat, so I have the name now.
Okay,
and
let me address the first part, Chandana. I'm sorry.
Yeah, sure.
Big data within insurance industry is limited because unlike investment firms, right, insurance companies do not share a lot of data with outsiders. So it's quite difficult to do a big data project. So that when I talked about earlier, looking at the US unemployment and federal lawsuits, right? So that's publicly available. So that's one rare cases. But even the largest insurance companies, because of privacy reasons and competitive reasons, don't change data. Now they have given, so some of the pattern recognition work was done through special arrangements with large insurance companies, but it's quite difficult. Whereas investment companies have managed to get their hands on a lot more data. The US, as you know, is a union, right? It is a union of 50 states. Each state controls how data should be handled and privacy requirements. So far it has been a difficult environment. We have been lucky in the past to do some pattern recognition research work, but it continues to be a difficult part of the analysis.
Thank you, Athula. There is a follow-up question from Janendra Bhogawat, who asked that previous question. Can you tell us about some things we have to consider when implementing or starting a startup related to the insurance industry?
That's a great question. I mean, with any startup, right? The basic questions would be, what is your idea, right? And then what is the product, right? Eventually you want to distribute or sell, whether it's a service or whether it's an actual product, right? And is there a real need, right? What is the business problem? I think the number one thing I would ask is there a real business problem that you're going to solve, right? Because you can have the best solution to some problem. If the insurance industry is not willing to spend money, right, it's not going to go anywhere. So there are ways to test that through insurance companies and large brokers and so forth. And with that, right, how do you distribute it? Are you going to try to distribute it directly to customers? If it is a personal lines product, you may have success, but there are already established large players. If it is a commercial lines product, most even small companies, right, they might buy cyber insurance, but most of the other things, they are likely to go through a retail broker. So can you sell it through a retail broker? Would they sell it? Is there enough money involved? Can you raise capital, right? And then that's a big question, right? Would venture capital or insurance companies invest capital in your endeavor? And you also want to ask, how would that get affected by the regulatory environment? As I said, each state in the US control, right, the regulatory environment. So if you have a fantastic product, but the insurance departments in each state or some of the big states say this cannot be done, they are becoming a lot more digital, a lot more tech savvy, but still, that's a big if. So I think you would want to do research on all those areas, right? How do you manage the regulatory environment if you want to get into the insurance industry? One of the biggest failures that we see is pure technology people coming into the industry and coming up with fantastic technology solutions, right? But they have not understood the underlying product, which is insurance. At the end of the day, you have to sell an insurance product in a regulated environment and pay for losses, right? So those two questions need to be answered up front before you enter.
Thank you, Athula. The next question is from Neranjaka Jayaratne. Thank you for the insightful talk. I have two questions. First, is deep learning being used as a machine learning technique in InsureTech? Second question, is blockchain being used in agricultural insurance?
What is the first question, Chandana?
Yeah, it is deep learning used as a machine learning technique in InsureTech?
So deep learning involves, right, both machine learning as well as neural networks, right? Not that I know. I have not seen applications of deep learning at this point. Some people claim that they have used, but I think get to that level, right? I mean, if you're Chubb, if you're Munich Re, Swiss Re, AIG, right? You can do it because you have decades of, right? Probably centuries worth of data. But have they kept in the right place to get through that kind of learning? I have not heard of any examples of deep learning. And excuse me. Yes, blockchain. I have heard examples in India using blockchain in agriculture. I mean, I don't know exact details, but I think that would be a great opportunity to get farmers and information, right? Weather patterns and fertilizer and other variables into a blockchain system, and then basically find a way to not just gather information, but provide a marketplace as well, right? At a very retail level. So I have heard of attempts in India to do that.
Thank you, Athula. The next question is from Salia de Silva. Great talk, Athula. Also, it is great that you have hired students from University of Colombo. The question, does the health insurance segment use AI to determine premiums?
I think they do, but I don't know any example. First of all, Salia, thank you. Good to hear from you. I think there are many large multi-billion-dollar companies with a lot of data. I think they use in some cases, but I don't know how exactly they use it. There are real restrictions on the predictability, right? If you have had certain type of illness, the insurance company knows, they know what medicines you're taking, and they know current research on, right? That in deteriorating, you're getting better, all that stuff. Should they be allowed to cancel your policy, right? So there are real questions around that, right? And I would not be surprised if they have figured out whether they should keep the policy or not. But I think there are enough restrictions around that, guardrails around that, that would restrict them from arbitrarily removing. I know there are ways to carve out, in the sense like as a company, when we buy health insurance for our employees, right? We buy a block of insurance. If somebody is chronically ill, in some other, we don't do it, we are a small company, but a very large company can say, you can remove these 3 individuals and the company will take care of their future cost to reduce insurance premiums. That already exists, right? Even without AI getting involved. So I think that those types of things, AI determining somebody's condition getting worse for a certain period of time and recommending reduction of limits or reduction of coverages could happen. But I don't think in the near term, the legal structure would allow them to kick that person out of the pool.
Thank you. Are there any other questions? We have a few minutes left for questions. Okay, we see one more. Yeah, the question is from Mahendra Munidasu. Fintech companies are considered disruptors of the banking industry because they compete with traditional banking products. Are InsureTechs considered disruptors in the insurance industry? From your talk, what I understood is that you are providing products and services to the insurance industry, but not a disruptor. Am I correct?
That's a great insight. First of all, yes, we are actually working with the insurance industry to provide speed and efficiency and cost reduction and risk mitigation. And we are disrupting on how the decision is made, right? But working with the insurance industry. So that's an excellent insight. We are not trying to become an insurance company, right? And then, so on the fintech side, there are two parts to it. The first part is the actual disruptors who are basically using at payment systems, right? Who are basically using at cryptos and other forms of money transfer mechanism and really trying to disrupt the banking industry, right? Money center banks, do we need that? We're asking the question, do we still need a dollar, right? Can we use crypto? So that's one side of it, but there's another clever side that is quite alarming, that is basically using fintech companies to do what we call regulatory arbitrage. In the US, the banking industry has to follow a very strict set of rules, right? They need to keep certain amount of capital in case people withdraw money suddenly, right? There are certain percentage they must keep within the bank in liquid assets. And they had to follow certain rules on, right? Who can transfer money and how, right? There are rules against certain people using the USO, right? Western banking systems. So there are companies that are there that are actually set up to handle the regulatory arbitrage piece, which means act like a bank, but you don't have to follow banking rules, right? So that's a dangerous area. So I think, you know, if you're looking at whether invest or follow, and in fact, the Square, right, could get in some trouble in the future if they're not careful with what they're doing, right? Is it really a new solution or is it just regulatory arbitrage? In the case of Square, Jim Dorsey, it's not very clear whether he meant to get around banking rules because he started the company basically simply to help his friend accept credit cards, right? His friend Jim McElvey had a business, couldn't accept credit cards, and Jim Dorsey and Jim McElvey basically started at that point Square, now Block. So the financial industry is at crossroads here regarding that issue.
Okay. Thank you, Athula. Another question from Janendra Bogavath. How are these types of confidential data collected for insurance? Is that from web scraping or any other special method? How do we create this type of large data sets to get the predictions? Is that from company-owned privacy data for years?
So there are multiple ways, right? If the insurance companies trust you, if they feel you're going to work with them, right, they could open up and provide you with data under fairly strict, confidentiality agreements. That's actually one of the best ways to do it, because they can give you very granular data to you and then help you understand that, right? Data itself is not valuable unless you understand the underlying conditions during each period, right? Each 10-year cycle. You can buy data, right? You can buy information about private companies. You can buy data about population demographics, right? So that's another method. There are a lot of companies who have done a good job actually over the last 5 years, accumulating and selling data in packages. And outside of Moody's and S&P, I used to work with them and say, hey, give us data. We'll try a mathematical model. If it works, we'll buy data, right? So if you keep your word, they are in fact willing to give you free data. And the web scraping is actually a fantastic way, right? Because right now, there are no rules, right? There are rules on what data you can share, if your customer data that comes with insurance applications, right? How you need to store it, how long you need to keep it, who can see it, right? All that data. But the web scraping data is not governed today, right? So that's an open environment. My example about airline pilots, right? Checking whether they have been caught drunk driving. Today you can do it, even though you are basically looking into somebody's private life. So I would say it depends, but web scraping is a wonderful example. Also, I talked about a doctor's office with just 2 male physicians, right? You can look into that, and you can basically look at the physician panel at a doctor's office. If you are convinced that adding female physicians reduces your risk, right? So I would look at all 3 parts, right? Insurance company, are they willing to work with you? That's a good sign that your idea has value, right? And basically buying data, if possible, without paying at the beginning, and basically web scraping.
Okay. Thank you, Athula. The next question is from Sudham Patirana. Do you expect there will be a significant overhaul in the US health insurance industry in the next decade?
Great question, Sudham. I don't know, because there are a lot of restrictions and regulations. But the fundamental idea that we are spending per person more than anybody in the world, right? And still not providing adequate health care, right? Is here, right? Everyone knows that. Now, I think there are some billionaires, right? Rightfully so, are looking into that. Can they provide Amazon? I'm not sure Amazon is still continuing with that during this cost cutting, right? They were thinking about it. We need a different solution, right? I think healthcare should be available to everyone, but over the next 10 years, I'm not sure.
Thank you, Athula. Are there any other questions? We have another minute or 2 left for the question, left in the question and answer period. If there are no other questions, we would like to go to the next part, which is the vote of thanks. The vote of thanks will be presented by the head of the mathematics department at University of Colombo, Professor Sanjeewa Perera. Professor Perera.
So good evening to Sri Lanka and good morning to US. On behalf of the Department of Mathematics, Faculty of Science, University of Colombo, first I would like to extend my sincere gratitude to Mr. Athula Alwis. I think the talk is very interesting and then timely. The topic is, of course, timely needed, not only for the West and the US, but in Sri Lanka also. Now also we are facing a lot of uncertainty. So the uncertainty mean insurance, right? So the uncertainty is like a risk involvement, and then people need to think about the mitigating techniques. So that's actually the insurance is the one of the way to, of course, mitigate the risk. So it's I believe like that this is a very timely, important talk, right? And you have actually presented it in the very well, and then so the looking at the questions also, I believe like that now the audience also highly appreciate it. So thank you for providing actually the very important talk in this. And not only that, the talk, of course, I would like to extend my sincere thanks because you have already taken our students providing the internship and then the hiring process, and then hoping like that you are hoping to take another 2. So thank you for giving the more opportunity to our students, right? And in this connection, of course, I would like to thanks the CUFSAA for organizing this talk series, and especially Professor Tilakaratna, who is the founder president of the CUFSAA, and then current president, Dr. Perera, and also the immediate past president, Dr. Chandana Goonetillke, and also the other committee members and all CUFSAA members. I would like to extend them our sincere thanks on behalf of the Department of Mathematics and University of Colombo. And also finally, I would like to thank who joined with us today, our students and the faculty members, and also the alumni members from US. So thank you very much. And good night for Sri Lanka, and then I think the goodbye for the US. Thank you.
Thank you, everybody.
Yeah, thank you.
Thank you.